Hey everybody. Hey, welcome to a live. I am live tonight. It is Wednesday. I just want to check myself before we start, make sure I can hear myself. Yep. So I'm live tonight. It's Wednesday, if you guys can see. If you're joining me tonight, thank you. If you're new to the channel, don't forget to subscribe to the channel, hit the like button, hit the share button as well, and hit that bell to know whenever we go live over here on the channel. I have been MIA lately, have a lot of things going on. So I decided that I would jump on live Wednesday, and also I'll be back live on Sunday, joined with a real estate professional partner. And as you guys can see, I was able to get on another computer. So now I have some of the background running, and I can share some stuff as well on the computer. So what we're going to do tonight, we're going to talk about this whole thing of institutional investors, depending on where you are located at. There are the institutional investors are starting to reorganize their portfolio. As you guys know, we have been talking about that a lot over here on this channel. So we are going to get into this video by Eco. Let me make sure I have their name right because we want to shout them out correctly. Eco no Fin. I think that's how you say it. Econofin or Eco no Fin. Almost like economy, believe. So I think it's Econofin. We're going to jump into this video that they have pulled back the curtains in regards to institutional investors. That's what we're going to talk about tonight. I'm going to play the clip. We're going to go through it. If you guys have anything that you want to say in conversation, please don't be scared to comment inside of the live chat tonight. And we are going to get started. And let me know your thoughts. Hey, what's going on, David? How you doing? I am live tonight, which is a surprise, and I'll be live again on Sunday. I just figured I would jump on tonight because I haven't been around. I've been dealing with a lot of, some family issues and things like that, but I'm able to jump on this computer here and kind of get this conversation started. So we're going to talk about those, like I said, institutional investors. It's not happening in everywhere. It's just happening in some parts of the country. So I just want to know anybody's thoughts. Whoever's watching this on a replay, let me know how you feel about this as well. Let's jump into it. So we're just going to do basically a reaction video to a video published by Econofin and see how it is. He said, pleasant surprise. Yes, it's a very pleasant surprise. I'm thinking about maybe doing Wednesdays and Sundays just because I don't have the time to kind of edit some of the videos in regards to putting out, weekly videos. So I might do pop up on Wednesdays and Thursdays, just not long on Wednesdays per se. So let's get into this video in regards to investors. It says Wall Street's $2 trillion housing bet is collapsing. They pulled Zillow data in regards to institutional investors wanting to invest in the market. So we'll let some of this play. We'll have a discussion. You guys let me know. Hold on real quick. I don't know what's going on. Let me know your thoughts and if this is happening in your area, because it's not happening.
What we're about to show you represents the largest institutional wealth destruction in American real estate history. And the mainstream media, they're staying completely silent about it. While everyone's been focused on individual homeowners losing equity, there's a much bigger story unfolding behind the scenes. Wall Street's massive housing bet, a $2 trillion gamble that began during the pandemic, is now collapsing in real time. And according to new data from Zillow, we're witnessing just the beginning of what could be the most spectacular institutional failure since 2008.
So on this chart, you can see there said metros with the greatest share of homes that lost value since last year. But homes aren't selling for a loss. Just 4% of homes have lost value since their last year. So again, this is based around institutional investors. If you have them growing in your area, a lot of them are pulling back now, right? They are starting to reorganize their portfolio. They are starting to liquidate their properties, and they're starting to reposition themselves in areas in which they can make sure they get a return on their investment. So these areas right now, they're kind of pointing out Portland, Oregon, San Francisco. So this California area, you have Phoenix, the Arizona, you have Nevada, Vegas, you have some Colorado parts, Denver, Texas, of course, Florida. They haven't mentioned Georgia, but Georgia is experiencing it as well, but they're not really talking about it much in this video, but you'll kind of see it as we go on. Let me know your thoughts and what you guys are feeling in regards to this. Hey, what's going on, Dad? Hey, what's going on, Croy? Thanks for joining. Appreciate it. Thanks, you guys, for coming on. Good evening. Good evening. And so let's get back into this video.
But here's what makes this different from anything we've seen before. According to Zillow's latest report, 53% of homes are now losing value year over year. That's the highest share since April 2012. But when you dig deeper into who owns these declining properties, a disturbing pattern emerges. The institutional investors who bought millions of homes during 2021 and 22, when prices were at their absolute peak, are now sitting on what industry insiders are calling the mother of all bag holds. Let me break down exactly what's happening here because the numbers are staggering. During the pandemic buying frenzy, institutional investors purchased over 300,000 single-family homes. Companies like Invitation Homes, American Homes for Rent, Progress Residential, and hundreds of smaller funds went on an unprecedented buying spree. They weren't just
And Progress Residential, Invitation Homes, Tricon, all those entities are all based in Atlanta as well, the Metro Atlanta area, Henry County, Fulton County, DeKalb County. Not as much in Cobb County per se, unless you go west, like into Austell, maybe Mableton area. You might get some here and there. But a lot of them bought South Clayton County area. They bought in DeKalb County area. Of course, Fulton County, which is Atlanta. Where
buying a few properties here and there. They were acquiring entire neighborhoods, often paying 20 to 30% above asking price. And here's where it gets interesting. According to CoreLogic data, institutional investors paid an average of $420,000 per home during their peak buying period in 2021 and 22. These same properties, based on current Zillow estimates, they're now worth an average of $365,000. That's a $55,000 loss per property before we even factor in carrying costs, property taxes, insurance, and maintenance. Do the math.
So as you guys see, so I'm going to start and stop this. So let me know your thoughts while we're kind of reacting to this video, because that's what we're going to do in this particular live. So in regards to, like they're saying, these institutional investors, they bought during that high pandemic period in which the mortgage rates were lower, right? So they were able to buy at a more reasonable monthly, I don't want to say mortgage, because some of them do have loans and some have MBSs, which is the mortgage-backed securities, and different things in which they were able to leverage as far as buying these properties. Some of them bought in cash here and there. And so what they were doing, they were buying to get a proper return on their investment at the time, feeling like you can, if I buy here, I can be able to price rents here, because at the same time as home values were going up, rents were going up. If you guys don't know, in the midst of the pandemic, things kind of came to a halt for a minute. And then some people were able to get a memorial, they basically stopped people from mortgages. I forget what it's called again. Jesus. Mortgage payment, rent payments, and different things like that. So people were able to kind of save a little bit who didn't want to pay. But at the same time, it kind of froze things for a little bit. So the rents kind of stayed stagnant for a minute. Home prices were trickling up a little bit. And then once we hit that 2022, 2023, all of a sudden, rents skyrocketed to the top. Home prices started to kind of level off because the equity had grew so much. And now, as you guys see, it depends. Every area is different. You might see a decline happening in your area or softening. And that's what we're kind of seeing right now in the Metro Atlanta area. We're seeing a softening.
Math with me here. 300,000 properties times $55,000 in immediate equity losses equals $16.5 billion in paper losses. And that's just the beginning. But wait, it gets worse, much worse. These institutional buyers didn't just pay cash. Many of them leveraged their purchases heavily, borrowing against their existing portfolios to finance this buying.
David said, looks like a decent place. Yeah, these places look very nice. They're very upscale. The videos in which, the houses in which they're showcasing on here, these are very nice homes. The institutional investors that bought down here in Georgia, some of these homes, the homes that they bought were like, regular looking homes. Like you said, decent looking homes, not like these wonderful, super renovated homes.
When you're leveraged 70 to 80% and your underlying asset value drops by 15%, you're looking at what Wall Street calls a margin compression event. In plain English, they're getting squeezed. But here's the part that should terrify anyone with a pension or 401k. The institutional money that flooded into housing wasn't just from private equity firms. According to SEC filings, major pension funds, including CalPERS, the Texas Teacher Retirement System, and the Florida State Board of Administration invested billions into residential real estate funds during the pandemic. Your retirement money was used to buy houses at the absolute peak of the market. CalPERS alone allocated $2.4 billion to real estate funds that were actively buying single-family homes in 2021 and 22. The Texas Teachers Fund put $1.8 billion into similar strategies. These aren't small positions. They represent meaningful portions of retirement assets for millions of Americans. And now,
I agree, David. If they go belly up, it will help with affordability. I definitely agree. The problem is, like is that these institutional investors are not everywhere, right? Throughout America, there's actually a smaller percentage in which people might assume, even though, like they said, they bought about 300,000 worth of properties. However, those were kind of allocated in certain states and certain cities, right? In certain states, you have, and in certain cities, you might not have as many institutional investors. You might have small mom and pop investors, which they're not buying at the amount as these institutional investors are buying. So with that being the case, we might see drops in certain areas as far as affordability in certain states, but you might not see it wide around every state, unfortunately. So it really just depends on where you're at. Everything's local, but because it's not like they bought in every state and every city. When you see this bust happening, it's going to happen just in certain areas, and those areas are going to experience probably the biggest drop in equity loss compared to other areas around the country. From what I'm looking at, don't quote me on that, but from what I'm looking at and from the data, and like I said, with me being in the metro area of Atlanta, Georgia, I know that this is starting to slowly crack down in this metropolitan in certain areas in regards to where these investors bought.
now, according to the latest pension fund disclosures, these real estate allocations are showing negative returns for the first time since 2009. The Texas Teachers Fund recently reported a minus 3.2% return on their real estate investments, with significant headwinds expected through 2026. Now, here's where the Zillow data becomes absolutely critical. The areas where institutional investors concentrated their buying are exactly the regions seeing the steepest declines. Florida, Texas, Arizona, North Carolina, Georgia. These were the institutional darlings during the pandemic. And according to Zillow, these are now the epicenters of the housing value collapse. Please take 2 seconds to help us out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, onward. Take Florida, for example. Zillow reports that condo values in Florida are down 9.9% year over year, the biggest decline since 2009. Hey, that rhymed. But single-family homes, where most institutional money went, are down 4.9%. That might not sound catastrophic until you realize that institutional investors own an estimated 40,000 single-family homes in Florida alone. Allow me to get more specific about the metro-level carnage. In Tampa Bay, institutional investors own over 8,000 properties purchased between 2021 and 22 at an average price of $385,000. Current Zillow estimates put these same properties at $340,000, a $45,000 per unit loss. That's $360 million in equity destruction in just 1 month.
And even in the sense of them saying in Florida, the institutional investors own about, what did they say, 40,000 homes. And the metro Atlanta area alone, they own over 70,000 properties. So it's basically about 30% of them are all single family rental homes currently. So they own 70,000. So they own more in the metro Atlanta area than in, according to them, just what they were saying in the state of Florida, there's 40,000. Just in the metropolitan area of Atlanta, they own 70,000. So I don't even know how much they might own in the whole state of Georgia as you go south or as you go north. So just think about that. If anybody, is looking in the Georgia market. Let's see.
Metro area. Miami-Dade tells an even worse story. Institutional buyers acquired 12,000 properties at an average of $520,000. Today's Zillow estimates, $465,000. We're talking about $660 million in losses concentrated in a single county. But the absolute worst institutional performance is in Austin, Texas. Remember, this is where tech money met Wall Street real estate funds in a perfect storm of overpaying. Institutional investors bought 6,500 homes in the Austin metro at an average of price of $475,000.
Sorry, you guys, that we're starting to stop. And this is, about reacting, having conversations. So let me check out the comments real quick. Corey said to David, should Nebraska be worried there are rumors of bankruptcy? I'm not sure. So I guess that's why that was towards David. David said, this might sound bad, but does anyone care if some giant hedge fund loses money? Yeah, I don't think most of us care. A lot of us are kind of betting on on them to lose money. It does sound, bad. It does sound unfair for us to want someone else to lose. But these hedge funds, these institutional investors, they came into a market in which they shouldn't be in, really, right? I don't think they should be able to play in the single family home market. I feel like smaller investors, the mom and pop investors, like the one-offs, maybe at the most, maybe, and I don't want to cap people's funds, but maybe like 10 properties or whatever, because we do want people to be able to create some type of strategy as far as how they want to outline their portfolios and different things like that when it comes to real estate. But as far as these institutional investors coming in the market and buying over 300,000 properties and literally taking home ownership away from everyday Americans who are trying to buy single family houses and to be able to live that American dream with real estate and kind of inflating that price, it gets to the point where it's like, do I really care if they lose money? These these investors, these hedge funds. David said hedge funds equals rental property equals FAFO. Exactly, David. So it's like at this point, and I think, well, we know a lot of, I know down here in this area, a lot of in the Metro Atlanta area, I should say, a lot of investors are now, like I said, they're reorganizing their portfolios, they're liquidating their properties because with the taxes going up, the insurance going up, and different things kind of pushing up, whether they're in a community with an HOA too, they're not making any return on their investment now. They're literally putting more in than they're getting out, and then any repairs or maintenance that have to take place. And to be honest, most of these institutional investors, when it comes to a tenant having a repair or some type of maintenance done on the house, they don't really do it. They're not really doing it up to par in regards to fixing things. They might have to sell their home in Aspen, Colorado. Exactly, right? Their $42 million home in Aspen, Colorado, right, David? They might have to sell their $42 million home in Aspen, Colorado.
Current estimates put these properties at $380,000. That's a staggering $95,000 per unit loss, totaling $617 million in equity destruction. American Homes for Rent, one of the largest institutional players, reported in their latest earnings that their Florida portfolio has seen material headwinds in property valuations. Translation? They're losing money hand over fist. But here's what should really concern you. These institutional investors aren't mom and pop landlords who can just sit tight and wait for the market to recover. They have shareholders, debt obligations, and quarterly earnings targets. When asset values decline this rapidly, they're forced to make difficult decisions. And the pressure is building from multiple directions simultaneously. Insurance companies that underwrote loans to these institutional buyers are now...
What did Croy say? Sorry, you guys. Clark, if they lose money, won't it hurt those with retirement accounts connected to them? I'm not sure. So I don't want to say yes. I don't want to say no. Definitely have to do more research and see. I know what they said in this video, that some of these funds were pulled out of different things like the Texas teacher funds and all that stuff. So I guess it just depends on where those funds were pulled from. And like you said, if they do lose, maybe it might affect their retirement. But I'm not sure in totality how it will affect the retirement. I guess it just depends on where the money is coming from. But I would think when you put in somewhere that you expect to get out of somewhere, unless I guess the company goes bankrupt and then maybe there's no return. But I would think when you sign a document, piece of paper stating that you get X, Y, and Z, that you should be able to get that out, as long as the company is still making profit. But I'm not a financial advisor, so I can't really get deep and dig into that. So I'm not sure. I don't want to, tell you yes or no in response to that, Corey. Sorry. David said, as a state, normally we have balanced budget. Yeah. So I guess it just depends. Definitely we had to dig further into that and just kind of see what that...
Demanding additional collateral as property values decline. Wells Fargo recently sent notices to 3 major real estate funds requiring additional equity contributions due to loan-to-value covenant breaches. Bank of America quietly reduced credit lines for 2 institutional buyers by a combined $800 million. Meanwhile, the rating agencies are starting to downgrade real estate investment trusts with heavy single-family exposure. Moody's placed 4 major REITs on negative watch, citing deteriorating fundamentals in target markets. When your credit rating drops, your borrowing costs increase, which squeezes already thin profit margins even further. And we're already seeing the first cracks in the foundation. Invitation Homes recently announced they're exploring strategic alternatives for portions of their portfolio. Industry insiders know this is code for, we need to sell before this gets worse. Progress Residential has quietly listed over 2,000 properties for sale in the past 6 months. American Homes for Rent has suspended their acquisition program entirely. Now, here's the part that affects you directly as a potential home buyer. When institutional investors...
Yes, if you guys don't know, again, like they said, these companies are quietly putting their properties up on the market. We're seeing it in the Metro Atlanta area. Also, if you guys don't know, Tricon, I believe, was recently acquired by Blackstone. And again, we can't blame everything on Blackstone, right? They're not the only people doing everything. But I believe Tricon was acquired by them. They also acquired a program called Home Partners of America. So Home Partners America was down in the Metro Atlanta area as well. And what that basically was a lease to purchase type of program similar to Divvy Homes. I don't know if any of you guys have that in your market as well. And Divvy Homes kind of put a stop to purchasing homes just because the way the market is trending right now. And so Home Partners of America was also, I believe, let me just check, because I believe they were also acquired by Blackstone as well. Home Partners, let me just look it up real quick so I don't give you guys wrong information. Home Partners of America acquired by Blackstone. I believe they were also acquired by Blackstone just recently. It said Blackstone Real Estate Income Trust to acquire Home Partners of America. Yes, so they were also acquired, and with them being acquired, since they did something similar to almost what Tricon did, Blackstone basically has ended that particular program of Home Partners of America. So in the Metro Atlanta area, some of those properties that were bought with Home Partners of America, they're now putting them on the market to sell as well. And Tricon has become that division where they're still allocating some of their properties for rental, for single rental family homes, but then they're also liquidating some of that as well. So like I said, they're shifting their portfolio. They're doing different things, these institutional investors, to try to create some more easiness on their books. And so there's a lot of quiet things going on in the background, just like they quietly, after a while, you guys saw the shock of the home prices going up in certain areas where the investors kind of swooped in at. So yeah, I don't know how you guys feel about that, but let me know your thoughts.
Investors start dumping properties en masse, it creates what economists call a liquidity event. Suddenly, markets that were starved for inventory get flooded with institutional quality homes being sold below purchase price. And according to Realtor.com data, we're already seeing this play out. Active listings are up 15% year over year nationally, with inventory now at the highest level since 2019. But here's the kicker. A significant portion of this new inventory is coming from institutional sellers who bought during the pandemic peak. This explains why we're seeing such dramatic regional variations in the market. States like New York, where institutional buying was limited, are actually seeing home values increase by 3.9% year over year. But in the institutional buying hotspots, the numbers tell a very different story.
So as we stated earlier, every state is experiencing something different. So like they have here in this video, New York actually has an increase because they don't have a very influx of institutional investors. So again, like we talked about earlier in this, watching this video and having a conversation, that every state is going to be different. Every city is going to be different because the institutional investors are not in every state and every city. So when I'm talking about the Metro Atlanta area, people are saying, well, I don't see that where I live in my area because your area is different. It probably was not flooded by these institutional investors. Again, they don't make up a lot of the housing market as far as percentage wise. So these 300,000 properties that they bought are allocated to certain states and certain cities. So you're not seeing the shift, or you're not seeing the softening as quickly in those areas or those states because they're not in there throwing properties up and slashing the price to try to balance out their portfolio. So you're not seeing that in certain areas. But this is, I figured I would have this conversation because I am in an area in which this is happening. So I just wanted to, bring a little light to it.
Texas, where institutional investors went on their biggest buying spree, now has 134,000 homes for sale, way above the long-term average. Tennessee, another institutional favorite, has 50% more inventory than normal. These aren't coincidences. What's happening is that institutional investors are quietly trying to exit their positions before the market realizes the full extent of their exposure. But there's a problem with this strategy. When everyone tries to sell at the same time, prices collapse. I did that with my mouth. So
my little miracle is back.
Let's put this on because I know sometimes I'm gonna take this off while I play. Sorry, you guys, because I know it'll happen, and then I'll remove it and bring it back on as the thing goes by. Because I know what happens with the commercials. They'll what you call the video. So we'll take it down, put it back on. Sorry about that. Let me know what you guys are thinking, how you feeling. Let's have a.
Here's where that story takes an even darker turn. Many of these institutional investors used complex financial instruments to fund their purchases. Mortgage-backed securities, real estate investment trusts, pension fund allocations. The web of financial exposure extends far beyond just the housing market. According to Federal Reserve data, total institutional exposures to residential real estate now exceeds $2 trillion. When you factor in all the derivative investments tied to housing, that's double the exposure we saw during the 2008 crisis. But here's what makes this situation potentially more dangerous than 2008. Back then, the crisis was driven by bad mortgages to individual borrowers. This time, it's institutional investors, supposedly sophisticated players, who made the bad bets. And unlike individual homeowners, institutional investors can't just walk away from underwater properties. They have fiduciary duties, debt covenants, and regulatory requirements that force them to take action when asset values decline. The National Association of Realtors predictably is trying to put a positive spin on all this. They're forecasting a market rebound in 2026, predicting double-digit growth in home sales and 4% price increases. But remember, these are the same people who said there was no housing downturn for the past 3 years. More importantly, the NAR represents real estate agents who benefit from transaction volume. They have a vested interest in maintaining optimism, regardless of what the data actually shows. The reality is much different. When you have $2 trillion in institutional money trapped in declining assets, you don't get a quick rebound. You get a prolonged unwinding process that can take years to fully play out. And we're only in the early innings of this unwinding. Here's what you need to watch for in the coming months. First, look for more strategic portfolio adjustments from major institutional players. When companies like Blackstone's Invitation Homes start talking about optimizing their geographic footprint, they're really saying they need to sell properties in declining markets. Second, pay attention to rental rate growth in institutional heavy markets. These companies bought properties expecting 8 to 10% annual rent increases. As property values decline, they're going to push rental rates even higher to maintain their returns. This creates what economists call a rental displacement event, where rent growth actually accelerates even as home values fall. Third, watch for changes in institutional lending standards. Banks that financed these massive purchases are now looking at their loan portfolios with serious concern. Tighter lending standards for institutional buyers means less competition for individual purchasers like you. But here's the opportunity hidden in the institutional crisis. As these sophisticated investors scramble to minimize their losses, they're going to create buying opportunities that haven't existed since 2012. Properties that sold for $450,000 at the peak are.
So, it's not to bring a doom and gloom. Of course, I don't want to stop people. Okay, let me get this right, because I don't want people to think that I'm here to stop you from wanting to do real estate, right? Whether buy or sell real estate. It's basically telling you, like, if you're going to do either or, to put yourself in a great strategic mindset to do it when you're doing it, especially in this type of market in which things are shifting and we're seeing a balance starting to occur depending on where you're located. And you're going from possibly a seller's market to a balanced market. Maybe you're even in a buyer's market, right? Because every area is different. So it's saying, as a seller, making sure if you're selling your house and you're not an institutional investor and you're a homeowner, strategically putting your house on the market, that it'll sell accordingly. Even with those investors, if you have them around you selling, you'll still be able to effectively sell, because typically Not all the time, but typically if you're a homeowner that takes good care of your house, you made sure you maintain it, you upkept it, and most buyers will probably want to buy your house more than institutional investor house if the price points make sense and they're kind of line on the same terms, right? Because you can provide them with an actual seller's property disclosure, because in the state of Georgia, they don't have to provide you with a seller's property disclosure. They can give you a latent defect disclosure stating that they never lived in the house. They don't know any defects of the house. They just check no, 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 no. And they can't make you aware of anything. Even if they do know that they didn't update the roof, even if they do know that they didn't really update the system, they can still say no, 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 no. Or the seller that owns the home, legally, they have to put in place that disclosure so you can kind of get more of a value out of them. And you can actually have a conversation and do, business with an actual property owner. Even though sometimes sellers that are property owners that live in their house, they do have more of an emotional attachment outside of a institution. So you get your pros and your cons with it or whatever. Also, like they said, it helps in a buyer side if you're in one of these areas where you see these institutional investors liquidating. And if you're okay with purchasing an institutional investor house that has been lived in, was rented out, they might not have taken the best care of the house. Because again, when it comes to servicing the house, maintenance in the house with these renters inside these properties, they did little to no work. However, it does pose an opportunity if you're a buyer and you want to buy something and you want to get into the real estate game, you will be able to enter at a more affordable level over time, if that makes sense. My dad said, David, I agree. Affordability. Hopefully the little guy has enough money to buy due to the present economy. Yes. Yes, and I'm hoping, people that's been waiting on the sidelines for the last couple of years because they decided to wait due to how the prices kind of climbed. If the shift happens in your state and in your market, because again, this shift might not occur the way it's occurring in certain areas because these investors didn't buy in every area. But if you see this shift occurring and it makes sense to you, if you sat on the sidelines, you'll be able to jump in at a good price where then as the years go on, over time, because it's not you buy tomorrow and then you sell the next year. But if you buy tomorrow and you wait, let's say 7 years to 10 years from now, you'll be able to see a return in your home if you decide to sell, right? So let's finish out this video.
Are now listing for $380,000. And based on current market dynamics, they'll likely settle closer to $350,000. The key is timing your entry correctly. According to our analysis of inventory trends and institutional selling patterns, the optimal buying window is likely to open in spring 2026. That's when the confluence of factors, seasonal inventory increases, institutional selling pressure, and continued demand weakness creates maximum negotiating power for individual buyers. But you need to be strategic about where you look. The institutional selling is concentrated in specific markets and price ranges. Florida's Gulf Coast, Austin's suburbs, Phoenix's outer ring, Charlotte's growth corridors. These are the areas where institutional money is most desperate.
In Atlanta, in the metro Atlanta area as well. They kept that out.
To exit. And here's something most buyers don't realize. Institutional sellers often have different motivations than individual sellers. They're not emotionally attached to properties. They're not trying to time the market for maximum profit. They're trying to minimize losses and meet portfolio requirements. This creates negotiating dynamics that simply didn't exist during the individual seller-dominated markets of the past. The bottom line is this. Wall Street made a $2 trillion bet that housing prices would continue rising indefinitely. That bet is now failing spectacularly. And according to Zillow's data, we're only seeing the beginning of the institutional wealth destruction that's about to unfold. For sophisticated buyers who understand these market dynamics, the next 12 to 18 months represent a generational opportunity. But you need to act strategically. Focus on the right markets and understand that you're essentially buying distressed assets from desperate institutional sellers. The housing.
So as we stated, I'll get this off the screen now. As we stated, and they kind of wrapped it up at the end, it's about being strategic. It's about understanding what market these investors bought in. It's about seeing if you're in those markets. Again, every market is not piled on in regards to these institutional investors. So I just wanted to kind of, go through that video, see if we had got some conversation started around it, see if your area is one of those areas that you feel like have been taken over by institutional investors. if you have been seeing any softening in the prices around your area, if you've noticed when you dug into the background, if it was an institutional investor. And real quick, I'll show you a property in our MLS. It hasn't gone under per se in regards to the price point, because some of these institutional investors, what they've done is they bought in 2021, and when they bought in 2021, when they bought in 2021, they tried to do a quick renovation on it, and then they turned around and tried to they rented it out. Maybe they try to sell it. Or they're trying to sell it now, and actually they're selling less than what they bought it for. And then some they bought real low, they're trying to sell high, and now they're slowly bringing the price down, and it's giving them a margin of a gap as far as selling. So I'll show you one right now that they bought before the pandemic happened in 2017, and they're trying to sell it now, and they're slowly but surely bringing it down, where that gap of that margin is getting closer and closer. But they bought it in cash, so they okay. But I'll show you real quick so you guys can see. So this is what I kind of do when I'm working with buyers, and anybody that is anybody that's currently working with me, they'll probably know, because they'll send properties over to me, and I'll dig in the background. I'll let them know what's going on. And so you guys you can typically see this too on Zillow as a consumer, but on the back end, I like to dig into the MLS, really go through the data just to see what's happening and what, things with where we can negotiate at, right? Where's the space? Where's the room? Who owns it? Have they refied in the last couple of years, last couple months? Because some people are doing that now, right? Homeowners, not institutional investors, but homeowners who recently bought, and they can't afford, the high-end cost of the property taxes. The mortgage is going up. They're trying to sustain. The job market has weakened. They're losing their jobs, and now they're refinancing. And now they're selling, and they're selling above because they don't have much space in order to bring money to the closing table. So you're seeing these refinances, you're seeing this selling, and the numbers don't make sense. So then they're at the point where they dropping into a point where they can't drop no more. Now they have to pull off the market and pray to God that they stay in their homes, right? But anyway, before I go on a tangent with this, I don't want to keep you guys too long. So this institutional investor bought it in 2017. And I don't want to go over here because I don't want to, it'll have their information over here along with other people's information. And I don't want YouTube to strike the video and take it down. So they bought in 2017. You can't really see, it's not a good picture of the house, but they listed it in June 2025 for $280. And slowly but surely, they're dropping. Now we're in December. They're at, I want to show the house address. They're at 199, because I don't want nobody to, because sometimes YouTube is funny acting now. Sometimes I'll show the property address, they don't do something, and sometimes I don't show it, and they hit my channel, and I'm like, okay. So at 199 now. So they're getting slowly closer to their margin and when they bought the house for 138. It's not, at the end of the day, like I said, they did buy it in cash. So they already feel like they made their money back already. They bought in 2017. They rented it out several times over. They probably already made half of their money back or most of their money back. And now they're trying to, dump it and get rid of it at 199. So this is an institutional investor as well. Again, if I show you their name over here, it'll show you the owners who used to own it. And I don't want to kind of put their information out there. But that is what's kind of going on right now in the market, in the Metro Atlanta market. Again, that's what we're seeing. I don't know what you guys are seeing in your area, but I just want to make you guys aware. So if you are currently selling a house or you are currently buying in the Metro Atlanta area, just make sure you dig a little deeper in the data. Make sure you're making the right decisions, whether you're buying or you're selling, to put yourself in a good position. Right now, and the market that we're seeing is more about a strategic, being very strategic and strategizing as far as when it comes to buying or selling in this current market, especially in those metros where we're seeing a lot of those institutional investors quietly selling and pulling back and liquidating. All right. So I appreciate you guys joining me tonight. Like I said, it wasn't going to be a long live. I just wanted to jump on here. I will be back on Sunday. I will be joined by Mike Patel, who is a local realtor out of the California area, and we will be discussing news in regards to what's happening. As you guys know, the Feds did drop 0.25 base points. However, the mortgage rates didn't really shift much. So we didn't see a shift there, but we'll jump on here on Sunday. We'll discuss. And I appreciate everybody for coming on here and taking the time out of your day to talk with me. Hey, what's going on, Jay? What's going on? Thank you for the information. No problem. Thanks for joining, Jay. If you guys, well, you probably don't know, Jay is also a YouTube. She creates YouTube content. And go over to her channel, you guys. If you like wellness content and things like those, you can join her channel. It's Psycho J Fox. She does a lot of some great content. And if you're into real estate and you're in Omaha, Nebraska, go visit David Matney's channel and give him a subscribe, a like, a share, along with Psycho J Fox. Okay, you guys have a wonderful night. Take care. And I'll talk to you guys on Sunday. All right. Bye-bye.